Hello students, today through this video clip we will practice how to value goodwill. As we discussed in class, the goodwill is only valued and created by an acquisition, the M&A process. And the goodwill is kind of premium. When the acquiring company acquired the company, the purchase price can be different from the fair value of net asset of the acquired company. So we say the purchase price is the fair value of for the acquired company or the consideration for the acquired company. So the difference between this, the consideration for the acquired minus the variable, the fair value of net asset for the acquired company is the goodwill, which is the premium. Okay, and then the net asset for the fair value of the acquired company can be calculated. The fair value of asset minus the fair value of liability of acquired company. Based on this understanding, let's practice. A corporation purchased 100% of common stock of B corporation for $100,000. When the A corporation acquires the B corporation, the stock, the 100% common stock will be extinguished. So on the acquisition, B corporation's balance sheet presented asset $115,000, cash, inventory, accounts receivable, PP&E, and goodwill of acquired the company. And then liability $30,000, and then equity, the actual net asset of this acquired company, $85,000 as indicated. Only difference between the fair value and the book value. Now we have information of the fair value of this, the B corporation, the asset. Fair value of inventory is $22,000. So the difference between this fair value and the book value of inventory is $2,000, and the fair value of PP&E is $44,000. So again, the PP&E on the book value is $40,000. The difference is $4,000 between the fair value and the book value. What amount of goodwill should A corporation report the consideration, the financial statements after the acquisition? Again, this goodwill is not the total amount of goodwill. That is a part of asset of the P company. Okay, so please don't be confused about this goodwill in the B corporation and this A corporation. Anyway, we will include this $15,000 of goodwill into the A corporation in presenting the consolidated financial statements of A company. So let's put this information into the journal entry when A corporation acquires B corporation. So the net asset, the fair value of a net asset is the cash. Now cash, how much is that? Right, $10,000. Then inventory, right? Inventory, is that $20,000? No, we have additional information. Here we go. $22,000 is the fair value. When we purchased any asset, any net asset, we record the fair value of an asset. That is the acquisition cost. So the inventory should be $22,000, not $20,000 book value. That is irrelevant information. And what else? Right, that is the exactly same as the book value is the same as fair value, because the question indicates that only the difference between the fair value and book value in asset and liability is inventory and the PP&E. Now the PP&E, what we have to record is right $44,000, because that is the book value, right? But the cash and accounts receivable and goodwill, we don't have the differences between the fair value and book value. So this goodwill also, I'm going to just write down in order to distinguish what the basis of the goodwill from. So the goodwill from the B corporation is the same as the fair value and the book value are the same. So I put the $15,000 exactly the same amount, right? So except for this, the inventory and the PP&E, we have the same value as the book value. Then how much did they pay? The A corporation, the consideration is 100. Oh, before jumping into 100, we have also the liability. The liability, when the A company acquires B company, the A company assumes B corporation's net asset. So the company assumes the total asset and the total liabilities. So we have to put the liability as well. So this is $30,000 as well. Now, how much was the consideration? Fair value of the firm as a whole in business, right? The cash paid is, that's right, $100,000. So we found, let me just check, that is $130,000. I think it is lower than $130,000 in the debit side. Why? Because you see here $115,000 in total. At most we put the $2,000 and $4,000 more than the book value in the total asset. Then it would be lower than the $130,000. So I'm going to just plug in of this new goodwill. The premium is minus, let's sum up all of this. So $9,000 is the goodwill newly valued. So let's put this journal entry, let's post this journal entry into the A Corporation consolidated financial statements after the acquisition. Now the cash, is already included here, 10,000 minus 100,000, as you can see. Then the inventory, how much the inventory? Right here, 22. Then AR and PP&E. Then the goodwill in total amount is 15,000 plus the 9,000. That is $24,000 should be recorded in total after acquisition for the A Corporation consolidated financial statement. Okay. Then liability assumed is $30,000. So as you can see that we include every the information, and the premium is $9,000. Premium is $9,000 through that the acquisition process. Okay. Okay, and then for the goodwill impairment, we will continue in the next video clip. Oh, before finishing, what if the consideration is lower than this consideration is lower than the total consideration is lower than the fair value? Then we record as a gain on the debit on the credit side. Okay, for example, what if they purchase like cash amount, let's say 800,000, not $100,000, and then as you can see that when I summed up this part, $121,000, but here that is 110. So we record the gain here, and then the difference between the debit and credit should be recorded as a gain. So gain amount is $11,000. We will discuss about this in the business combination, business combination, the topics in the next week. Okay, see you in the next video clip. Bye bye.